So we're gonna send this presentation out to everybody. So how to win in the stock market. So the stock market is a game, but you have to know how to play the game. And the stock market is similar to a game of musical chairs. And so if you imagine the stock market as a big game of musical chairs, the company are the chairs and the investor are the players. And that simply means like you have to get in early. You have to pick your chair before the crowd rush in. And if you find a solid company, right, which is the chair, you sit down first and you stay put while everybody else around you is circling around you, trying to figure out where to sit. By the time the music, now what is the music? The music is the hype. The music is the media. You're going to hear a lot of things on TV. You're going to hear people saying a whole bunch of stuff, but that's not what makes a company tick, right? So you have to realize that a company is making money in real time. I talk to a lot of people who always want to get invested in stocks. They always want to buy stocks. And they always say, well, okay, I want to buy a stock, but how long does it take for me to buy a stock? How long does it take for me to hold it? How long does it take for me to make money? Well, that's a big question to ask. Well, first of all, what stock are you buying, right? Because we all know that if you buy trash in anything, in any market, if you go buy chicken that has salmonella in it, if you go buy, um, just inferior products, stuff that's not good, you know it's not going to last long. And I think a lot of people really think in the stock market that cheap is value, but cheap doesn't mean value. Just because you buy a cheap stock doesn't mean that the stock is valuable. So what I do in my seminars is I have to train people to let them know, like, no, just because you see this stock is $1, $2, $3, $4, it looks cheap, but what is the bang for your buck that you're buying, right? Because if the company is not making money this year, if it's not going to make money next year, if it's not going to make money 4 years from now, then you're buying an inferior product. So going back to the analogy of musical chairs, you're gonna hear a lot of hype, especially even now in the stock market with this tariff situations. And me, I believe like right now, majority of the stocks in the market are somewhat oversold. And most of them in about maybe 2 or 3 weeks will be oversold, right? So if you're already in position, if you're already in play, so when the music stops and others are trying to find that chair, guess what? You can lay back. And that's what I do with stocks. I see a stock that I'm looking at a company that may not be earning tremendous profit, but they're doing some things well, right? So let's say I bought a stock last year called Palantir, which they do AI solutions for the government, right? Different type of AI solutions for different sectors of business with the government. Well, Palantir wasn't super profitable last year, but what I seen was they were killing their revenue projections. Like they were making a lot of money, but they were spending it on expenses. But as I begin to watch this company, I begin to see their expenses compared to their revenue begin to dwindle. So the revenue started increasing, increasing, increasing. And because their revenue started increasing so much, their expenses didn't matter, their debt didn't matter. And then they had a lot of money to be able to you know, started kicking back to the shareholders and growth. So Lori said, shout out to the Palantir call it. We called it out super early. Yeah, I mean, we literally buying it like at $17. So we were buying it super, super cheap. So because we had the ability to look at the revenue of a company and was able to really see what that company was doing, we were able to get in early. Again, the analogy of musical chairs, right? So you got to understand in stocks, the music gonna always stop. In stocks, the music gonna always stop. But I want to just like get your mind to understand this is that there's always gonna be an upturn in stock. There's always gonna be a downturn in stock. But if you buy good companies, if you buy good companies, it really don't matter the price. And when I get through this presentation, I'm gonna show you if you held Apple for 5 years or even 2 years, you made more money, right? And I'm gonna show you. So today's price don't matter because today's price is always gonna beat out tomorrow's price. Simple as that. If you can hold any stock for 2 to 3 years, you're gonna make money, right? Because stocks move in cycles, and that cycle is quarter by quarter base, right? So as long as the company making money, long as they're hitting their revenue targets, long as they're making a profit that they're able to kick to the shareholders, that stock gonna make money. So again, wrapping up the musical chair analogy, this is the 3 points I want you to make. So the stock market game is like musical chairs with money instead of music, right? So basically, the company is the chairs, we are the players. If we pick a company that's doing well, right, that's has a value price, right? A lot of people are looking at the company, they're saying, well, I don't know if they want to buy it because the company went down 20 or 30%. Like Ronnie was talking about NVIDIA, but NVIDIA still has a lot of underlying value because they're making a lot of revenue. They're making a lot of money quarter by quarter. So if you find NVIDIA, Ronnie, let's say you find NVIDIA, all you got to do is sit down, buy that stock before everybody else. And then when you sit down and buy that stock before everybody else, what's going to happen? When everybody in the media start talking about NVIDIA, or they make another chip like we seen today, or they do a deal, you already see it, right? And so when the music stops and others rush to find a chair, right? When they're trying to look for the stock and they see the stock performing well, what's going to happen? People are going to start rushing in because people are irrational and emotional. They don't want to lose out on the hype. They don't want to lose out on the trend, right? So you already sitting back chilling, right? Relaxing. You already being cool, relaxing, chilling, everything. And then guess what? Now everybody's coming in. They want to buy NVIDIA now. And watch this. The stock is too late to buy it at a value price. So now everybody else is buying the stock from you, right? Because you got in, they got to get it from you, but they got to get it more expensive, right? So maybe you bought at $100, now the stock is $300. Now, because they late to the game, simple supply and demand, they got to get in on the back end and not the front end. So the earlier you play the game, the better your seat is. The earlier you play the game, the better your seat is and the bigger your chance to win. In the stock market game, the winners are the ones who are not panicking, right? Because if the music changed and you got in early, it don't matter if we playing jazz, it don't matter if we playing hip hop, it don't matter if we playing tango. Like my Amazon stock went down 30%, but I bought Amazon at 85, right? So it can go down another 70% for me, and I'm gonna still buy more because I know it's one of the largest companies in America. Everybody buys from Amazon. So it's all about getting in early. So the one who learns the rules early, pick a great seat, stay in position long enough to win big, are going to make the most money. And this is why I tell people, if you hold your stock, you're going to make way more money than just trading. I know a lot of people say, man, I want to trade. But people want to trade because their economic or financial situation is not good and they want to get some quick money. But quick money always going to move fast and is always going to leave out your hands, right? So our job is not to get quick money. It's about building what we got, because when you build what you have, you get the habits. And when you get the habits and you know how the system work, then guess what? If you lose 10 grand, you know how to make another 10 grand because you built the habits. What's the discipline? Trading is a quick hit. It really don't give you the discipline because the stock market, the way it trades on emotion. It trades on what people are thinking. And how many know sometimes what people thinking is not really is, right? So to go back to another thing, another analogy, buying a stock is just like waiting to get a Beyonce ticket, right? So if you are in the stock market game and you're on the wait list, right? We're gonna call the stock market the Beyonce ticket, right? You're positioning yourself early, hoping that the value of what you signed for will go up when the spotlight hit. So let's say if you ever bought tickets, right? If you bought a Beyonce ticket, right, and you're on the wait list, you if you got in early, what you're gonna do is you're gonna beat the demand, right? And let's say you wanted to flip that ticket. If you got in early, you're going to bet that the demand will rise and you will secure a seat before the price skyrocket. That's the same thing with the stock market game, right? The stock market game is just like trying to secure that Beyonce ticket. So if I get in early on the wait list, I'm going to get a ticket. I'm going to get a guaranteed ticket. And the price of my ticket is going to go up. Same thing in the stock market. If I'm buying a good company and the company is making money, and it's doing what it's need to do, and they're hitting revenue and earnings projections, then because I paid for my seat early, I get to reap the benefits. But everybody who paid for their seat to the Beyonce concert last, they're gonna have to pay astronomical prices. The same thing with the stock market. So one of the things about the stock market is just like with that Beyonce ticket, right? You might buy your Beyonce ticket right now, right? But you're not going to receive the instant reward of going to the concert. You say, why? Because the concert is in July or August or September, whatever it is, right? So you got to wait, right? So you might not see the rewards, but as the buzz builds, as the show nears, your early decision becomes more valuable. And so in the stock market, when you're buying stock early, it's that you're investing before the hype, right? And you're trusting the company will grow. So it's a system of trust, like everything. Everything is a system of trust. Anytime you're doing business, anything you buy, if you go to a store, any market, you're trusting that market, that person, that business, that company to give you a product, right? Which is good for value, right? So if you go to the market and you go buy apples, you trust in that Walmart, Winn Dixie, Kroger's is going to give you an apple that is valuable, that is delicious to eat, that's healthy to eat. They're not going to give you a rotten apple, right? So as companies, brand conscious, right? Talk about brands. As company builds a reputation and a rapport with its consumers, then they become more trusted and people buy more from them, right? That's why ads and commercials is big, and then people try it out. Then you try a burger out, and then you do a campaign. You say, "Oh man, that burger is good," right? And then now people just continue to go and buy a McDonald's hamburger because they've seen that the burger tastes good, right? So same thing with the Beyonce tickets. If you buy early, as more people take notice, as more fans are rushing into Ticketmaster, the price is going to rise, and your early spot is going to become it's going to be worth more, right? And you can either enjoy the show, that's long term investing, or you can sell your ticket for a profit. That's what we call trading. Now, both rewards require discipline, right? And the discipline is you've got to believe in the value of a company before the crowd catches on, right? So there's a lot of new companies that are coming out. There's a lot of new companies that are all upon in the stock market in the three indices, and that's what I'm going to talk a little bit about today. So, if you're in the chat, just let me know as this is moving. Let me know y'all can see it moving. Just in the chat, just put a thumbs up or whatever. Just let me know that y'all can see it moving. If you're in the chat, all right, cool, cool, cool. All right, let me move this over. So I said the stock market is like any other market. People buy and sell based on value. We know everything that we do in life has an underlying value. There's nothing that don't have a price. Everything in this life, you got to buy it. So the stock market is like any other market. Now, there are terminologies and there's complex systems and complex terminologies that a lot of people don't understand. That's why they don't invest in the stock market. But if you know the underlying factors of a market, then you can make money in the stock market. So all people do is buy and sell based on value. We talked about value, based on timing and emotion. Now, this word emotion, I want to let you know is you got to get your emotion out the game because Over the short term, you might lose money, right? But if you know the company is a good company, the company is made and created to make a lot of money. So even though in 1 month, 2 month, 3 month, you might lose 10, 20%, if you hold that company 12 to 24 months, then you're going to make more money than you ever made invested in the stock market. The difference is in this market, patience. Now, I know a lot of people are not patient, but patience is going to be your biggest discount. If you are patient, you can buy stocks at good prices. If you are emotional, I mean, if you're not emotional, you won't hype in and just buy a stock because everybody else is buying, right? But if you do hurry up and buy stock before everybody is buying it, while everybody is buying it, then you're gonna need patience. Because if you're patient and you buy a good company, if you wait for 3 years, you're gonna make more money. And I'm gonna show you that. So patience is your biggest discount, and discipline is your best deal. So what is investing? Investing is the act of allocating money. So taking your money that you make off your job, taking your money that you make off, an idea, right, or whatever resources, and you put it into an asset. The asset that we put it in is the stock market or the bond market, right? And then whatever that venture is or the project that we invested in, we are believing for an expectation of making money. That's what generating income is, making money. We want to make some profit over time. If I'm investing in this company, I need this company to make money for me. Now, if I'm going to invest in this company, y'all need to research about the company. So I tell people all the time, the easiest way to get into the stock game is really just to invest in companies that you like. Like if you go to Victoria's Secret all day, that's ticker symbol VSCO, start buying some Victoria's Secret, right? Start seeing how much they're making off of you and off all the other women. Like, I tell young people all the time, like, you need to be invested in DraftKings. DraftKings is increasing year over year with billions of dollars of revenue. I think it was like $5 billion worth of revenue, right? Just off the first quarter. You need to be buying DraftKings, right? So these are the things, like Lori said, like me and Starbucks. I've been holding my Starbucks shares for a long time. I've been holding my Starbucks shares probably since 2018. I remember when Starbucks was like 40, $50, and I had bought it. It ain't that no more. But also, when you buy stock, one of the things that you need to understand is too, you start getting better deals. Like at Starbucks, if you own the stock, if you own a certain amount of shares, they're gonna give you gift cards, they'll give you deals and all that. But you got to know, like certain car companies like Ford and GM, you got a certain amount of stock, they give you a 5-10% discount on your cars, if you're buying a car. So all of this is the benefit to you. And I'm just trying to give you the game for free so you can make life easier for yourself, right? Because life ain't getting no easier. Prices are rising over in time. That's inflation. Inflation basically is the cost of money. So as the government is pumping more money in, right? Money today is not backed by anything. It's not backed by gold. It's only backed by the goods and services that the American economy produce. We call that gross domestic product, right? But our gross domestic product is not producing at the same level as how we spend it. So if that's the case, your dollar that you have today is going to depreciate in value. And I'm going to tell you something that's going to blow your mind. Over the last 100 years, right, the dollar has depreciated 99% in value. You don't have to ask me about that. You can go research that yourself. So if you know that the dollar that you have is going to depreciate, right, 30% in the next 20 years, why would you not try to do something to protect your money so you can have more money, right? So when you invest, you're going to have to research. You're going to study companies. That's why I say buy companies you already know. Risk assessment. Just know the smaller a company is, the more risk you're taking. The bigger a company you buy, less risk you're taking, but you're not going to make the most money. The bigger companies, you're going to make less money. Smaller companies, you're going to make more money. So off the top, more risk, more reward. But with more reward, also come more risk. Right. So you got to really think long term. And really, long term is really not that long because I'm 32 years old now. Lori's about the same age as me. I remember when we was teenagers, right? And I've done a couple of big trades in my life where I hit a couple of six-figure trades twice or three times, right? And that was not, it was just only by patience, right? I hit it with Facebook. I just hit it with Palantir. I hit it with a company called Seagate Technologies, right? So it's possible with a small amount of money. I'm gonna tell you how much money I put in Facebook. In 2012, I believe it was in April, when Facebook was $38 a share, I bought it. And I bought maybe like, I think I bought 350 for myself, 400 for my dad. And it was like 11, 12 grand. And so, it went all the way down to 18 in 2013. I mean, he was getting killed. Zuckerberg was getting killed. He was all in the news. But I knew that this was going to be a wave that people were going to get to. And I knew ad revenue was going to be something that was big, even though it wasn't big at that time. And so I just stuck to my guns and never sold. And because of that, you know, that was a six-figure trade. And I still have those shares to the day. I haven't sold one of them. And so hopefully, if it's do good in the next 15, 20 years, that'd be something I can give to my kids. So I want you to know that investing, as we see, is not trading. Investing is not trading. It's not hype. It's not luck. Investing is strategy, is research, and the biggest thing is playing the long game. I know a lot of people don't like to play the long game, but I promise you, there's going to be a lot of people in the crypto trade, and crypto is my specialty. So if I got crypto questions, I answer them after this. But playing the long game, if you play the long game, then you're going to win. So I, the most important thing I want to teach you is the index. Now, some of y'all might not know this. If you don't know this, this is going to help you. So in the stock market, there are indexes, right? Or we call them indices. And so these indices is every stock that you buy, you're going to buy them, and there's going to be an index that tracks the stock performance. And so an index is only a statistical measure that tracks the performance of a group of assets. What is it tracking? It's either going to track stocks, it's going to track bonds, it can track, mortgages, any type of investment, any type of specific market, any type of sector of business. And they are used to represent and monitor only the health. So if you see, like the Dow 30 right here, which is the top 30 companies in America, the largest 30 companies in America is the Dow 30 index. So that'll be the Amazons, the Walmarts, you already know the biggest ones. So the Dow 30 only tracks, we call them blue chip companies. They're the best of the best, right? It's one of the oldest and the most widely followed indices in the world. And any track, any stock or app that you got, the Dow 30 always going to be at the top. Always going to be at the top. Then you got the S&P 500. Now we call the S&P 500 the market, and the reason why we call it the market because instead of the 30 biggest stocks, it has 500 of the largest stocks, right? And we call it the market because it is regarded as the most accurate representation of the U.S. stock market, right? So it don't have just all the tech stocks in there. You got oil, you got food companies, like General Mills, you got companies like utilities, like energy, and Pacific Gas Company and OGE, and you have also drillers like Alaric and MLP, and what's another a driller? Well, they got so many different drillers out here. Back in the day, they only had like 50 of them, but they got so many of them. So that's why I always tell people to buy the market because you want the diversification. Now, I'm going to tell you why diversification is important for you now, but in probably 10, 15 years, you ain't got to worry about diversification. Now, I'll talk a little bit about that. And then the NASDAQ 100 is an index that only includes 100 of the largest non-financial companies, right? Mostly now it's become the tech index. So majority of the companies that's in the Nasdaq 100 are technology and innovation companies. I can't even say that I got tongue tied, but it's all right. So what is the stock? Simply, a stock is ownership. It's ownership in the company. When you buy stock, you own a small piece of a company. It's just like If you go to a pizza place, uh, you know, they got 12 slices. Simple as that. When you buy stock, you're buying a slice of a company, right? And the slice of the company is called a share. The slice of the company is called a share. So when you buy stock, all you're doing is buying a share. And so simply, I ain't gonna give it no more deep than that. When you buy stock, you're buying a piece of a business. If the company grows, if they make more money, if they make profit, your stock gonna go up in value. And if the company gets bigger and bigger and bigger and bigger, it's gonna pay you dividends. Now, what is dividends? Dividends is a payout that the company gives you because you own a piece of the stock, right? So it's like a sweetener. So what companies do, the reason why they pay dividends is because they say, okay, you might want to hold a stock for a year. It's going to take the company a year to make money, right? Because we know we told you that companies make money in cycles. Those cycles are quarters. We have 4 quarters. Every 3 months, there's earnings and revenue projections, right? We're in that time right now. So if you just turn on CNBC, 39, I think, on regular cable, 355 if you got direct TV. If you got other, services or you streaming, you can just go on YouTube. Every day I think at 8:30 and 4 at 8:30 Central Standard Time, 9:30 Eastern Standard Time, turn on CNBC. Just see what your money is doing. 3 o'clock, 4 o'clock Eastern Standard Time, turn on CNBC, see what your money is doing. So the dividends is a sweetener. So the company will pay you 4 times a year. Dividends paid 4 times. Now they got companies that pay monthly dividends, but I won't talk about that right now. I'll tell you a little bit about those. So, and that sweetener is the company is going to give you money to hold a stock until they make good on their projections. That's all a dividend is a portion of the profits that a company gives to the shareholder as a sweetener to get them to hold the stock. Now, every company don't pay dividends. If a company is smaller or if a company is trying to grow at a rapid rate, they're not going to pay dividends. They're going to use that money for research and development. They're going to use it for innovation. But if a company is already big, like a Walmart, and they're making money and they way better than their competitors and they don't have to compete, usually those bigger companies are going to pay dividends. Um, if you got a question, I don't really want to rush through it. If you got a question, just put it in the chat right now. I'm gonna give me about 3 minutes. If you do have a question about this, um, I want you to ask me because I don't want to just be rushing and I want to make sure y'all getting this information because I can think it's self-explanatory, but sometimes when you're teaching, you want to make sure everybody get it. If it's all good, just type in the chat. We good to go. Or good to go. GTG. It don't really matter. Or just a thumbs up if you got a question. Okay. All right. We good to ride then. Okay. Cool. All right. So what is a bond? Simply, a bond is a loan, right? It's a loan you can give to a company or a government. Now, what I want to tell you about this is if you're loaning your money to the government, if you're loaning your money to the government, you got to understand that the government is the safest entity you can do business with, right? Because its balance sheet is bigger than a corporation. So it's the safest investment that you can make. So they got two type of bonds. There's treasury bonds, right? There are government bonds and then corporate bonds. And I'll tell you the difference between the two. So a treasury bond is a government bond, right? You can buy treasury notes. So that's 1, 3, 6 month notes. Then you have 1 year, 3 year, 5 year, and 10 year bonds, right? Of course, the longer your bond is, the more interest you're going to get. But I'm gonna tell you why that's bad. Because bonds and interest fluctuate, right? So the interest rates all the time was going up and down. So, I know people who bought bonds 5 years ago when the interest rates were 2% and they locked in 10 years on the bond, but now interest rates are 4.5 right now. And so they still getting paid 2% when interest rates are 4.5. So if you're going to buy a bond, just understand that. If you're going to buy a bond, just understand that. Okay. Okay, I got a question. You said if you can you explain what everybody is talking about with the the 10-year bond and the tariff impact. Okay, yeah. So the 10-year bonds is a gauge on how the economy is going to move. So we told you that interest is the price of money, right? We told you interest is the price of money. So how do Americans live in this economy? Nobody live in this economy by their own money, right? Everybody lives by credit. So a lot of people really think they're doing good in life, but nobody's really doing good in life because nobody really owns anything. The majority of Americans, majority of Americans, they're paying a car note. They got a lien holder. And if you got a house, you have a lien holder. Those people can kick you out the house, right? So everything that is done in this country with businesses, governments, and even with individuals is made by credit. So interest is a big thing. Interest is a big thing because if interest is more expensive, right? We told you the price of money. If it costs me more, right? If it costs me more to buy a product with interest, like a car, I'm not going to buy it, right? So if my car note was 3, 4% locked in for 6 years and now it's 7, 8%, which means my car note now double, people are not going to be more inclined to buy things with interest. So the 10-year treasury bond is an indicator, right? Along with the 2-year treasury note, it's an indicator, right? To let us know how people are going to consume. Basically, go to the bank and buy larger products. So a higher interest rate environment is bad for the economy. So what our Fed is doing is trying to find out when they can basically cut rates. But it's more complicated with that than that too. And I'm just gonna let you know what's going on. So the Fed can't cut rates if the economy is mixed, right? And so right now the economy has mixed signals. Now, what are the mixed signals? The mixed signals is unemployment is not high, right? So unemployment is one of the major gauges to tell if the economy is going to go to recession or the economy is going to go bad. So right now, unemployment is like 4.4, 4.5%. A bad unemployment reading is 6%, right? But what is bad? The dollar is falling, right? We have more debt on our balance sheet, right? We have people are being delinquent on their home payments and their car payments, right? People getting laid off. So all that's locked in, including with tariffs. So tariff is not a good thing right now. So if I when I tell people this, people say, what tariff is going to do? Well, tariffs is simply a tax on you as a consumer, right? So when our government puts a tariff on a country, that country don't pay the tax. We as the consumer pay the tax. So if we knowing this, right? If you know this, then you automatically know that if we're seeing prices rising, if we're seeing people getting laid off, and with my economics brain is always saying that the economy is going to get worse before it gets better, right? And so this is why you can't trust the government because the Fed, not the federal government, but the Federal Reserve, right, which is a think tank group that puts liquidity in the capital markets, which then puts liquidity in the real market. What you mean by that? The Fed puts money into the banks. The banks take that money and loan it out to the consumer, right? It's called a trickle down economics, right? That's why when the government always do capital injections by putting money into the economy, they never give the individual like you and me money. They always give corporations money because corporations can hire, corporations can get people bonuses and stuff like that. So it goes down from Big Street, which is the fat cats in government, down to Wall Street, which is stock market, down to Main Street, which is everybody else. And hopefully that answered your question, Lord. So always look at how interest is going up or going down because cheap interest means people are going to buy more products, right? Because if you got a $400,000 house with a 2% interest rate, that payment gonna be $1,300 a month. But if you got a $400,000 house with a 7% interest rate, you're talking about a $2,800 house. And consume, and when the economy is consumed, what does the government get? Tax revenue, right? Okay. So, yeah, if you want me to explain it further, just let me know in the chat. Okay. So, a bond is a loan you give to a company or government. In return, they promise to pay you back with interest after a certain period of time. Now, bonds are paid what we call semi-annually. All that means is twice a year. Dividends are paid four times a year. Bonds are paid twice, right? So usually the bonds are paid. Like I got a couple of bonds, not that much, but a couple $1,000s worth of bonds. They usually pay them on February and August. February and August, the government pays them on. So think of a bond like an IOU. You let a business or a government borrow your money. They lock in a contract and they agree to pay you interest, right? We're gonna pay you a little bit to keep you happy, right? A thank you. They're gonna pay that to you regularly, and then they're gonna give you back the full amount later. That's all a bond is. Now the key is this: just like in the real world, you cannot give everybody money. You cannot give everybody money, right? Because some people are not good for it. We got family members. I think I got a couple family members on the phone. So we got family members. That you give money, they ain't giving the money back. So each bond has a credit worthiness status, right? So it's from all the way from AAA plus, right, which is the best bonds you can buy, all the way down to like CCC negative, which is the worst. It's the crap. It's the poop of bonds. So if you ever buy a bond, just make sure you're buying a AAA bond or a AA bond. Even if it's a corporate bond, make sure you buy a AAA bond or a AA bond. Now, the difference between corporate bonds and government bonds, because a corporation is smaller than the government, they're always going to pay you more interest. So the average interest rate on a corporate bond is about maybe 5 to 8%, and the average interest rate on a government bond is right somewhere between 4.2 and 4.5%. So because you're taking more risk investing in the company than investing in the government. So, my favorite product, Lori, I always talk about get the ETF, get the ETF, get the ETF. And people always like, man, you always talk about ETFs, man, what an ETF is. So simply, an ETF is just a exchange trade fund. It's an investment that holds a collection of different assets. So basically, it's an instrument that behaves like a stock. So a company, right, takes the investor's money, right, like me, you, Lori, Ronnie, all of those who are on the phone, those who are going to watch this on YouTube, take the investor's money, right, and they pool it into an asset like a stock or a fund. And basically, they'll buy, let's say they'll buy 100 companies. So they'll put Apple in there, they'll put Amazon in there, they put Walmart in there, they put DraftKings in there. And then all those companies are going to perform, right? Some are going to go up, some are going to go down. But from that, you're going to get a weighted average, right? We call it a weight range, right? Or weighted average. So on an ETF, sometimes there's different type of ETFs. I'm not going to go into that today, but on the next class, I'll talk a little bit about that on different types of ETFs, right? Usually an ETF will have the bigger companies or the best performing companies to be the high weighted average. So like if a company is like an Apple, they'll buy 15% of that. So let's just say the fund is a $30 billion fund. So $4 billion of stock they're buying Apple. And they'll buy like $1 billion in Amazon and 500 million on Walmart. And you can go any ETF you have, they have what they call prospectus sheets that you can look at that'll show you the holdings of what all the stocks or bonds they have. And they pool all those stocks in one fund, and then that fund trades like one stock. And you can buy it or you can sell it just like a regular stock on a stock exchange. So that's good because it protects you and it diversifies, because we know if you got all your money in one company, if you just took $1 million and you got $1 million, like let's say in Tesla, and Tesla go down 50%, you lost $500,000. But if you invest in an ETF and you got all these companies, the Tesla go down, but you got 30, 40 companies go up, well, that fund might go up 2% or 3% or 4%. So it's protecting you as an investor from basically volatility of a stock. So again, instead of buying one stock, you're buying a whole group of stocks all at once, and it helps you spread your money, right? Which means basically diversification without having to pick every stock yourself. Now, why is this important? Everybody know some of these top stocks are expensive, right? Even though we got fractional shares, you know, Facebook costs $500, Nvidia costs 100. Sometimes when you get your check, you don't want to spend $500 on one stock. You might want to buy your children some food or whatever. Go to a dinner date with your wife or your fiance or whatever. So the ETF gives you exposure to those stocks at a cheaper cost. The ETF gives you exposure to those stocks at a cheaper cost. Now, this is probably going to be probably the hardest terminology that we're going to talk about tonight. So, if y'all got questions about what an ETF is, I'm gonna give you about 2 minutes. You type it in the chat, or you can even, if you can unmute yourself and can ask it. It's all good, either in the chat or you can unmute yourself. If anybody want me to explain what an ETF is? If not, I'm gonna keep on going. All right, we cool. We cool. All right. Okay. So diversification means just don't put all your eggs in one basket. Now, why do people in the stock game tell you never put your eggs in one basket? Because you're just learning about investing and you don't know about stocks yet, right? You don't know about stocks yet. So because you don't know about stocks, if you buy one bad stock and you put all your money in there, you're gonna lose a lot of money. So this strategy of diversification is spreading all your money across different investments so that if one goes down, others can help balance it out. So I use the analogy of a fruit smoothie. Let's just say you're making a fruit smoothie. If you only use bananas and the bananas are rotten or bad, the whole smoothie gonna be ruined. But if you got a lot of berries in there, you got a lot of milk and good fresh milk and good protein in there and good sugar. Even if one of the fruit tastes bad or maybe it's too ripe or whatever, the smoothie gonna still taste good. And that's what diversification and ETFs do. Even if one stock go bad, even if two, five, 10 stocks go bad, if you got a ETF with 100 different stocks, right, then guess what's going to happen? You're still going to make money. So that's basically diversification in a nutshell, right? So all diversification does is lower your risk. Now, if you like to get risky and frisky, then you already know. Me, I'm a type of person, I started investing during the recession of 2010, 2011. So when I started investing, we were already in the hole. So people always say, man, you be buying stocks and you never be mad losing 20, 15, $30,000. I'm like, it really don't matter to me because first of all, it's all digital. Second of all, I know what the stock is going to do in the next couple of years. And third of all, when I started, investing, our country was in the worst economic environment we ever lived in, besides the Great Depression in 1933. So diversification just lowers your risk by mixing things up. Now, I want to talk a little bit about this, and then I'm going to show you how stocks go up and go down. So how do companies make money? Well, y'all already know because many of you work for businesses or, you have your own business. Companies sell stuff. They either sell services or they sell products. They either sell services or they sell products. Okay, let me see what Ronnie said before I get it. Is there certain amounts of different ETFs that you will invest in at one time? Would it be hard to make a profit if I only have a few shares of a lot of different ETFs? That's a good question, Ronnie. So, you can have a list of different ETFs. Now, with ETFs, they got different type of ETFs, right? So what we call it is broad-based ETFs and sector-based ETFs. Now, what's the difference between the two? I'm gonna let you know, Ryan. So a broad-based ETF is just a company who makes a fund, and they just buy a bunch of the top largest companies in America, right? But if you want to get a little bit more risky and frisky with it, what you can do is you can buy sector-based ETFs, right? So that MSTX that the girls are buying in our group, that's a sector-based or a company-based ETF. So all that ETF does is buy a company called MicroStrategies. MicroStrategies, basically, all they do is buy Bitcoin, right? And so they buy double the amount of the tokens of Bitcoin, which gives you the ability to have 2x on your money. So the girls right now, if I'm looking, let me just see the numbers on what they did just this week. I know it was crazy because I was looking, I got MSTX too. So just in a week, the girls made 9%, right? Which is crazy to make because sometimes you can't even make that in 4 months. If you look at right the stock market, which is the S&P 500, if you look at what the S&P 500 made, you already know it didn't make no 9%. So let's pull up the S&P 500. Hold on. So it made 1.31%. So y'all already killed the market in a week. You already killed. So Ronnie, if you told somebody, yeah, man, man, I just made 9% off my money, they're gonna be like, you a liar, but you can show them because it's proven. See, what's better, 1% or 9%? I had to learn this. It took me years to learn it. I'm just giving y'all free game so y'all don't have to make the mistakes that I made when I was 18, 19, 20, 21. You could come out already making money. And I'm going to just give y'all strategies. And all you really got to do is plug and play. But I want to teach you how to fish, right? Because if I teach you how to fish, you're going to always have fish in your refrigerator. You're going to always be able to skin them and everything, right? So this basically that, Ronnie. So yes, you can buy different ETFs for different sectors. So if you want to invest just in banks, they have a bank ETF. It's called, I'm putting in the chat, it's called XLF. You want to buy just energy and gas companies, it's called XLE, right? If you want to buy Bitcoin, it's IBIT, IBIT ETF. Or I think it's BitX, which is two level Bitcoin. So there's all kind of ETFs that you can buy. And they're usually between $30 and $50. So it's always cheap. That's why when people tell me, man, I can't invest in stock, I'm like, well, you're paying for lunch a week, $25. Take one of them days that you're paying for lunch, go get a salad and a water, and then pay yourself. Because nobody gonna pay you besides you. Your job is not gonna pay you. So Laura said she bought XLE on 2022. Yeah, I mean, Laura, you bought it like when it went up to 100, and it's still doing good. I mean, Laura, you bought it so dirt cheap though. Like you bought it like at 30 when I told you to buy it. Laura been, buying it. Like every time I hit her, to tell her to go buy it, she'll go buy it. Like when we was buying it, we were literally buying it. I think it was like more like 2022, Lori, when it was like $30. And Lori bought it, she made 100% off it. So it can be done. I'm letting y'all know because y'all young, it can be done. You just gotta just have discipline. Not you ain't gotta be the smartest person. You just gotta be disciplined. So how do the companies make money? They sell services, iPhones, burgers, clothes, software. The money that comes in is called revenue. So that's just the money that comes in. It's like your paycheck, right? That's revenue, right? And they use that revenue to pay for things. So um they use that revenue to pay for stuff like employees, supplies, rent, and marketing, right? And whatever is left over after they pay their bills, after they pay their employees, that's called profit. That's the earnings, right? So if the earnings go up, company make more money, the stock go up. Level forward. If you own a share in that company, remember you are an owner of that company. That company has what we call revenue earnings. They have earnings calls every quarter. You can uh participate in those calls because you're on and you can ask questions and you can talk to the CEO yourself. So any company that you're invested in, you have the right to talk to the CEO because you're an owner of that company. So companies can do two things, right? They can reinvest the profit to grow the business, or they can share the profit with you. We talked about through dividends. So we told you that dividends is a cash reward that goes to you. So simple as this. Let's say Nike sells a pair of sneakers for $100, right? They're selling it for $100. That's the price. $60 goes to making the shoes. paying the workers and the advertisement. That's the revenue after revenue. So they made $100 on the revenue. $60 go to expenses, and then that $40 profit. So if you own Nike stock, some of that profit going to come back to you, either by the stock going up or by them paying a dividend, which is a reward to you because you own the stock. Simple as that. So if you got a question, just put it in the chat, please. So how does stocks go up or down? That's what everybody asks me. Everybody asks me. They be like, man, bro, I know you know about the stock game. You've been doing it a lot. I've seen you make money. This is what you do. And it's so simple that when I tell them this, they're just like, no, 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 give me the more technical term. Well, there's a lot of technical terms, but I'm gonna make it as simple as it is. Stocks move because of supply and demand. That's it. Just like anything else. People buy and sell. You know, if people go, you know, buy the new Jordans and they sold out, they might hike the price up. We talked about the Beyonce tickets. If people buy the tickets, the resale value is going to be crazy. You already know that because it has a built-in demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. So I want you to think of it, we told you, like a sneaker drop. If everyone wants the new Jordans, you already know the price going to go up because there's a demand. If you got a million people want a million Jordans, but you got another million people waiting for those Jordans to drop, then you got a built-in demand. So people gonna want it regardless. So you can say, you know what, to get this new drop, instead of charging y'all 150, I'm gonna charge y'all 175 because we got a built-in demand. Now, if nobody wants the shoes, you already know the price is gonna fall. You ever seen some Jordans that was like 150, and then you go back 4 5 months later, they 110? That's because they got a bunch of supply of those shoes in the store. And now they got to hurry up and get rid of those shoes because they got to get new inventory. It's the same thing happened with stocks. So people buy or sell stocks based on two things: based on news or opinions. Sometimes a powerful person can talk about a stock and they don't even know what they're talking about, but because people believe what they say, people will sell a stock or buy a stock based on an opinion about the company. So it could be news about company making more money than expected. Usually, if the company makes more money than they was expected to make, the stock usually gonna go up. So this is earnings season. So as you watch it at 3 o'clock, just turn your TV to CNBC on 3 o'clock. Start to look at the earnings at 3 or 4 o'clock on CNBC, and then after the earnings, start to look at what company is going up or going down, and you're gonna see at the end of the earnings huge increases or decreases in the stock. So you'll see something like if the CEO quit, like when a United Health United Health Group CEO got murdered in New York. Remember the stock went down, so the CEO quit the company or had the company had a bad quarter, or when Chipotle had salmonella in the chicken. Any type of bad news to the stock, that's going to make the stock go down. If there's a big new product coming, people might be interested in buying their own in stock, might be buying the stock. So it's something new, like say Apple about to launch the new iPhones, and always in September or October, people gonna be like, man, I need to hurry up. That's the time when I'll be like, man, I need to hurry up and buy Apple. I always buy Apple always in the beginning of the fourth quarter. So that's a little tidbit if you're gonna buy Apple. Because that's when the iPhones drop. That's when they make the most money. So that's it for the presentation today. If there's any questions that you want to know, you can unmute yourself or you can drop it in the chat. But I just want to show y'all a list real quick before y'all drop it in the chat. I just want to show y'all, if y'all don't believe me, we could pick any stock, right? We could pick any stock over the last 2 years, and I'll show you it made money. So I'm gonna show you. So let's go to finance. Yahoo Finance. All right. So let's look at we'll start with the big company. Let's look at Apple. We go to Apple. We type in it. Yeah, I know my internet is a little bit slow. Bear with me. I don't know what's going on today, but it's super slow. There we go. So it's got to load the chart up and everything. So if you look at Apple over the last month, you're gonna see it's down 5%. Right? People say, "Oh man, that's crazy." If you look at that, if you look at it at the last 6 months, it's down 13%. But if you look at it over a year's time, it's up 17%. That's just holding it for a year. You could have bought Apple right at 169. So it shows you the more time you in the stock game, the more money you're gonna make. The more time you in the stock game, the more money you're gonna make. Hold on, let me see. So now, yeah, this is the best time to buy. No matter, even if the market go down, some more might go down by another 6, 7%. This is the time to buy because the more you're in the game. Now, let me show you how sexy it is after 5 years. Boom, 184%. So that's why I always say today's price always gonna beat tomorrow's price. Because if you look at the price in 2020, it was $70, $77, right? So it don't matter what company you do. I can even show you Tesla. Let's show you Tesla. You say, man, Tesla is beat. I would never put my hands on Tesla. It's 254, man. Down over a month. 6 months is let's see, hold on, let's see. Well, even Tesla is still up, right? Because even the 6 months, you waited 6 months, you could have bought it at about 165. So, the hype and all that about the stock going down and stuff, over the last month, it went all the way down to 220 and stuff. It's just hype. Because if you go 1 year, it's up 57%. And if you go 5 years, it's up 400%. So all that CNBC jargon, they just be talking. I can show you another major company. We can do Nvidia. Everybody like, man, Nvidia is down, man. What you doing about Nvidia? So you see Nvidia is down 7% for the month. 6 months is down 14. But when you go to 1 year, up 30, right? You go to 5 years, 1,500%. So I always try to tell y'all, if y'all young, y'all 20s and 30s, hold these companies for 2, 3, 4 years, right? It ain't even rocket science. You look at AMD. People's like, man, what about AMD? AMD got killed 6 months. You go to 1 year, but when you start going to 5 years, it ain't no comparison. 73%. So long as you're willing to hold the stocks, and that's going to be continuous. Any number that in any company that you build, that's a big corporation. I've heard people say anytime is the best time to buy if you believe in the company. That's what it is, Lori. Simply, if you're buying these 154 billion, $200 billion companies, right? You're gonna make money in the game. Let's show you TQQQ, right? People was like, why are you telling your people to buy TQQ? Why are you telling them to buy that? Man, they ain't gonna make no money off that. Well, let's look at it. 5 days, y'all made 28%, right? That's in 5 days. Boom. 1 month, 19% is down. 6 months, 31% is down. But watch this. 1 year went to 10, 5 years, 200%. So you had a million, you made another 2.2 million. So that's what I'm trying to do right now with y'all is build the habits. Because if you build the habits, let's say, Ronnie, you take that, you keep loading up $50, right? Every week. You got 4 bands, right? You do that for 5 years straight. That's 20 bands. Your 20 bands now become 40 bands. So that's 40 plus 20 equals 60 because that's 200% on what you put in. So if I put in 20 and I get 200% of that, Ronnie, by the time what you about 24? By the time you my age, you gonna outpass me with money because you got time that I don't have. Right? You still a young buck. I'm 32. So you got 8 years I can't get back. So you're gonna be making more money. If you just do that, you're gonna make money. And if I just did all, that's 12,000%. Since 2010. 12,000% means $1 you made $12,000 over the last, Lori, look at that. That's over the last 15 years, Lori. If you just put $100 in here, we will all be in Mykonos. Now, I ain't noticed. I had to learn this. But if you just would have put $100 in this over the last 15 years, it's a no brainer. You know, And you're gonna see this repeatedly and repeatedly and repeatedly and repeatedly and repeatedly. No matter what asset I can do, we can do Walmart, we can do. People talked about Target, right? So people was like, man, Target. Everybody is booming Target, but if you go 5 years, it still went up 250. Now did it go down? Yes, but look, over those 5 years, it still went up to 250. You could have got your money at 80, rolled it to 250 and cashed out. So it don't matter what company that you buy, if it's a big company and it's making money, you still gonna see moments where the stock is gonna go up. Even the bad ones, like Target, like they trying to do restructuring and everything. They stock over the last month is getting obliterated, 40%. Now I'm not saying that Target is a good company, or a bad company. They got to do a lot of restructuring because it ain't just about what happened with people boycotting them, but this is about their company as a business is not marketing to the consumer where they need to be marketing to. So it's just understanding this game and knowing how to really master this game and really trying to understand that patience. That's all really 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 is, and that's why I'm always telling Lori, you know, um get into this game. Get into this game. Now, listen, I'm gonna tell y'all a couple of companies that I'll tell you to buy. Um, you want to get this BYDD? Why? It's a car company out of Asia. They're the largest car company, electric vehicles in the world. 150, 45 billion. Go ahead and snatch that. You look over 1 year. I started buying around this area. The beginning of the year, I told Lori in March to do it. She would have made up 83%, but she probably was messing around with Brian or whatever. She ain't listened to me. But it's okay, Lori. We're gonna redeem you. They're gonna continue to grow, right? Y'all need to go buy, if y'all eating that kava, y'all need to go hurry up and go snatch kava. Because that's gonna grow like Chipotle back in the day. Okay, let me see what Ron is saying. So he said, so all in all, the biggest losers in the stock market are people that aren't patient. That's it. They ain't patient enough to hold. People always tell me, man, I bought a stock. I mean, how long you bought it for? A month. You ain't patient enough to hold. Y'all go snatch Kava. Kava is down over the last 6 months, but it's still up 43%. This is a new stock. It just did the IPO and it's up already 43%. And they're gonna do about another 78 businesses next year. So go snatch Kava because this is gonna be $100 billion stock, Ronnie. So every time you got a little extra bread, go buy this. It's gonna be $1,000 stock. Just remember I said that. In the next 5 to 10 years, this stock gonna be about. They're gonna have buildings everywhere. So go snatch Kava. Ronnie, for the men, um, go get DraftKings too. Go get, I think that's DKNG. Yeah, go get DraftKings too. Go snatch that while it's cheap. Go snatch it right because it's gonna be about a $50, $60 stock in about 1 or 2 years. Okay. See, 5 years up 116, it went all the way to 60, and it dropped all the way down. It's going back up because people still like to do their parlays. So Lori, get my boy Brian on this. Get my boy Brian on this. Go get DraftKings for the women. VSCO. Go snatch Victoria's Secret. Go snatch Victoria's Secret. Go hurry up and get that. Now they got a $25 year target on that, so y'all can make some good money on that. Make some good money on that. They consolidating right now, but don't worry. Go get some of that because they going back up. They at the bottom of the bottom right now in their trading scale. So you want to go snatch that. And they still got underlying value because their earnings are still profitable. You see, the earnings are still profitable. So they're in a restructuring too. But go snag that. Go get all the top magnificent sevens. Go get all the top magnificent sevens you can get. Go get all those. I'm telling you. So I'm building up a woman's strategy, women's stocks. If I know they have Ulta Beauty and stuff like that. I think Ulta, if y'all shop at Ulta, go get you a piece of that. Go get you a piece of that. Go 5 years, 77%. Go snatch Ulta. And they got a couple of other ones that I'm gonna send over to y'all. But it's just simple as that. If you're willing to be patient, if you're willing to be whole, I'm not trying to sell nobody nothing. I'm just trying to give you the game, and that's basically the game in a nutshell. So that's it I got for y'all today. If anybody got questions, stop sharing. If anybody got questions at this time, y'all can unmute yourself, or you can put it in the chat. If not, we I think that's Lori. Lori, you unmute yourself.
Yeah, so I will say Every single stock that you have ever sent me has been profitable in the 2 years after you sent it to me, whether I've invested in it or not. I continue to watch, and literally everyone that you have sent me has jumped at least 20% in 2 years, which
Oh
is
yeah, hundred
crazy.
percent.
People be like, oh, 20%, that ain't nothing. 20% is a lot when it comes to the stock market, especially within 2 years. So, y'all, listen to what he's saying. If you have the money, put the money in, because I really didn't start listening and locking in until about 2022, which is when you told me to buy XLE, XLF, those, and hold them. But if you got $50 a week that you can put into a different stock every week, even if you got to rotate and you do $50 on this one this week, $50 on this one next week, put the money in it, y'all. Like, for real. Because we trying to retire early. Like,
100%.
that's the
I
goal.
don't want y'all to have to
Retire
work, especially my
early.
family. I want Ronnie to do way better than me. I want all y'all to do good. So that's why I'm always hard on Lori. And I'm not saying that she ain't doing good, but I'm always hard on her because I'm like, Lori, I need you to be in 5 years a millionaire. So every time I see something, but once I do my analysis, I'm always like, man, okay, Lori, getting this one. Nah, I'm getting. I know we all young, and look, we all got to build our nest egg. So I know Lori, she might say, look, I ain't got it for five, but I can go put one in there. Still, even if you put the one, at least you made something. Like Palantir, Lori could tell you, we bought Palantir dirt cheap. Like, I think I got Lori in at like 18, and we rolled that thing all the way to 110. I was in Vegas. I'm like, Lori, now it's time to sell. And she got out, we got out. So, I'm on this thing every day. This is what I do. This is how I make my money. Even though I got other businesses, I take my money from my businesses and I invest. And that's helped me throughout my whole life because I always knew, your company could fire you, they can get rid of you. If you pay yourself, you're gonna always be doing good. Ronnie, smash that Kava. I promise you, bro. You're gonna do real good on that. I'm on it hard right now too because I know that's a company that's gonna be a triple bagger, and you really don't get no triple bagger. That's what I'm talking about. 100% type of stock, 300%, and you really don't get no triple baggers type of stocks like that. When you get a couple. You get a couple. My first one was Facebook, then Seagate, then my third one was Palantir. You don't get those 500,000. You don't get on those waves like that. So I'm trying to get you your first one. Really. And Lori let you know, like, she's just letting you know this ain't nothing no false. This something I did, this something I showed her. And I'm giving it to you for free. I just like seeing my people win. And everything I'm gonna do, I'm gonna give it to y'all for free. Cause, you know, on the back end, I'm always give my blessing. So just do it. If you do it, I promise you. Y'all made Lori, they made 29% in 1 week. Like they got people like, man, that ain't nothing big. But I'm like 29% in TQQQ, 29% in MSTX. Y'all don't even understand how hard it is to make 29%. Y'all did it. Some of y'all first weeks invested like heavily. So it just blapped on my mind. Like, so you already know the Beyonce tickets, Lori. You might well just get yours and Brian's. You know what I'm saying? On July, snag them because you're gonna have about 1,500, $1,500. Might well snag that, and you should be able you should be able to see Beyonce herself personally. That amount of money. So you know, thank y'all for listening. I'm gonna send it back to y'all on the link once it's all downloaded. It'll be also in the Instagram too, so y'all can be able to look at it, review everything as well, and then go back, send it to somebody, send it to somebody who wants to learn about it. But that's it, Ronnie. That's it. Y'all all know. Hold it, buy it, hold it. You're gonna do good. I promise you that. So y'all have a good night. We're gonna continue another one of these probably next Tuesday. We're gonna get some how to look for a stock, how I look for a stock. So all you need to do is simple addition and multiplication. They got a lot of metrics that people use, but I'm gonna tell you to show you the simplest metric to find out if a stock is a good deal or not. So next Tuesday we're gonna be locked in for about 45 minutes. So all right, y'all have a good night. Pleasure talking to y'all. We're gonna get back on this on Tuesdays. Keep on going hard in the paint on them stocks. Anything you get once you get your check, automatically keep on buying. So good night, everybody.